Do you want monthly dividend income, good diversification, and some high yields? I've got you covered. The ETFs I'm going to talk about today are great options to put in your tax-free savings account because they are safe investments you can let sit and just watch the dividend income roll in. The first ETF is the BMO Monthly Income ETF, ticker symbol ZMI. It trades on the TSX, and right now it offers a yield of 4.7%. It's an incredibly high payout, and sure enough, you'll collect the payment every month of the year. Its expense ratio of 0.20% isn't too high, especially when you're locking in such a high yield. There's plenty of incentive to just hang on to this one. The ETF holds a position in other ETFs, so you're getting a lot of diversification here as the fund is invested in other BMO funds which are focused on dividends. There are some good high-yielding options in here giving you a balance of fixed income and equity positions. But in terms of overall sector exposure, it's financials that account for 27% of the fund's holdings, followed by tech at 17%, and healthcare is the last big sector, accounting for around 11%. It's a pretty diverse portfolio, and it's heavily focused on North America, with Canadian and US stocks taking up the lion's share of the stocks you'll have exposure to. This year, the ETF has risen by 5% thus far, and that doesn't include its dividend. So it's a solid investment which can generate recurring cash flow and also the potential to rise in value. If you want to collect $1,000 in annual dividends from this ETF, you'd need to invest around $21,300 based on its current yield. Next up is the iShares Canadian Dividend Aristocrats Index, ticker symbol CDZ. It's on the TSX and its yield is a bit lighter at 3.6%. Its management fee of 0.60% is also a bit high. But what's attractive about this fund is that it strictly focuses on high-quality Canadian dividend-paying companies, which have been increasing their dividends annually for at least 5 straight years. The term dividend aristocrat refers to dividend growth stocks with strong track records for growing their payouts. The allure of these types of stocks is that your dividend income can increase over time because these companies regularly raise their dividends. That's not a guarantee, of course, but these are among the safer dividend stocks you can own. There's more of a methodical process in selecting these stocks, hence the higher fees that come with it. There are 88 holdings in this ETF, but the largest one, Allied Properties REIT, accounts for just under 4%. So there's plenty of diversification here and not a lot of exposure to any single stock. You see that TELUS and TD, a couple of high-yielding TSX stocks, are also among its top holdings. In this ETF, financials dominate the fund, accounting for 23% of all stocks, followed by energy at 15%, real estate at 13%, and utilities at just under 11% round out the sectors in double digits. Overall, however, there's some good diversification with this ETF, and by focusing on dividend aristocrats, it can potentially be a more attractive option if you want some additional safety. This year, the ETF has risen by 13%, which is a great return to go along with its monthly dividend payments. To collect $1,000 in annual dividends from this ETF, you'll need to invest about $27,800. Last but not least on this list is the iShares Composite High Dividend Index ETF, ticker symbol XEI. This TSX-based ETF has the highest yield on this list at 5.1%. Its goals are simple: generate monthly dividends and charge low fees. Its management fee is 0.20%, which is in line with other low-cost funds you'll find on the TSX, and it's similar to the BMO fund that was first on this list. There are 75 holdings in this fund, but one thing you'll notice right away is that it is a bit more top-heavy than the other ETFs. What I mean by that is you have multiple stocks that account for more than 4% of its total holdings, and some are over 5%. TD, CNRL, TC Energy, and Enbridge are the big names that have a weight of 5% or more. Those are fairly safe dividend stocks, however. So those are stocks you may not mind having a big position in, especially if it means you're getting a great dividend from it. But there's no denying that energy stocks play a much bigger role here. They account for 30% of the fund's holdings, and when you add in financials, that's around 60% in those two sectors. Utilities add in another 13%, so that's almost 3/4 of the ETF that's in 3 sectors. Again, not as diverse as the other funds here, and so you want to consider whether you're okay with energy stocks in particular making so much of the portfolio. Canadian bank stocks are among the safest dividend stocks out there, so that's a non-issue. But it comes down to whether you want all that exposure to energy stocks. Energy stocks are historically good dividend payers, and under US President Donald Trump, that sector should be in okay shape. If you're okay with the fund's exposure to energy, then this ETF can give you the best of both worlds, a high yield and low fees. This ETF is also the best performing one on this list. As of Tuesday's close, it's up over 15% this year. That's a great return, and it's probably that exposure to energy stocks that's helping it. Because of its high yield, you'll need the least amount of money to invest in this ETF to collect $1,000 in annual dividends. Investing around $19,600 would be enough. So those are the 3 high-yielding ETFs you may want to consider for your ETF today. Let me know what your thoughts are, or if you have other ETFs that you think are better. Let me know in the comments. Thanks for watching, and remember to like and subscribe.